What's up, everyone? Welcome back to the channel. Today, we're tearing up the usual script. We're not deep diving into a 10K filing or parsing Fed speak. Nope. Today, we're talking about an engagement announcement. Yeah, you heard me. Because when pop megastar Taylor Swift and NFL champion Travis Kelce announced they were getting hitched, it wasn't just fodder for the tabloids. For those of us watching the markets, it was a legitimate, quantifiable economic event. It was a catalyst. This is the Swift effect in its purest form, a phenomenon so powerful we now have a whole field of study for it, Swiftonomics. And what I want to show you today is that this is way bigger than one celebrity couple. This is a paradigm shift in consumer behavior, brand marketing, and the financial markets themselves. So, we're going to break it all down. We'll start with the immediate shockwaves on Wall Street, zoom out to the mind-boggling macroeconomic numbers, look at the weird new ways people are literally trading on her personal life, and then, most importantly, we'll figure out the real investment thesis here. How do you play the massive booming fan economy without getting completely wrecked? Let's get into it. The moment that engagement news dropped, the market went to work. It was a perfect illustration of how cultural events now translate almost instantly into economic value. Any company even remotely associated with the couple saw its stock ticker light up like a Christmas tree. Let's look at the big three. First, Signet Jewelers ticker. This is the world's largest diamond retailer, owning brands like Kay, Zales, and Jared. The stock immediately popped, closing up over 3% on the day of the announcement and jumping another 6% the next day. Why? Pure speculation. Word got out that the pillow-cut diamond on Swift's finger was a style that Signet's brands specialize in. That's it! That's the entire thesis. A rumor about a ring design sent the stock soaring. Next up, Ralph Lauren. Their stock climbed a respectable 2.5% over 2 days. The logic here was even more direct. In the official engagement photos, both Swift and Kelce were decked out in Ralph Lauren. The dress she wore sold out almost instantly. Analysts at Jefferies pointed out that Google searches for Ralph Lauren dress went absolutely vertical, providing a direct catalyst for the stock price. But the most dramatic winner was American Eagle Outfitters AEO. Their stock rocketed over 8% in a single day. This was a masterstroke of timing. AEO chose that exact moment of peak cultural hype to announce a limited edition collaboration with Travis Kelce's own apparel brand. Now, this is where it gets really interesting for us as investors. The market's reaction reveals a massive asymmetry. The perceived value of a celebrity connection can create hundreds of millions of dollars in market cap overnight, a number that is almost certainly disconnected from any actual short-term revenue. Let's be real. For a company like Ralph Lauren, with over $6 billion in annual revenue, one sold-out dress is a rounding error. It's financially meaningless. So, the market isn't pricing in future cash flows from that dress. It's applying what I call a narrative premium. Investors are betting that the association, the halo effect of being linked to Swift and Kelce, will lead to this broader, unquantifiable boost in brand image, foot traffic, and consumer sentiment. This has created a new and very volatile asset class: narrative stocks. These are companies whose value temporarily detaches from their fundamentals and instead gets pegged to how close they are to a powerful cultural story. Investing here isn't value investing, it's a speculative bet on the lifespan of a story. And this brings us to the cautionary tale of American Eagle. Their genius PR move overshadowed a much grimmer reality. Before this pop, AEO's stock was down over 23% year to date. The fundamentals were weak, with sales growth flatlining. Analysts had already been waving red flags, pointing out that their previous celebrity marketing campaigns failed to solve long-term issues like a lack of pricing power. Dig deeper, and it gets worse. Financial analysts pointed to razor-thin operating margins of 5.7% compared to the S&P 500 average of over 18%. They were over-leveraged, with a debt-to-equity ratio 3 times the market average. While the stock might have looked cheap on some metrics, it had all the classic signs of a value trap. The AEO surge is a textbook example of a fundamentally weak company getting a speculative, news-driven bump. It proves that while the Swift effect can create juicy short-term trading opportunities, it can also mask significant long-term risks. It's a hype trap waiting to spring on unsuspecting investors. Okay, so we've seen how this shakes up individual stocks. But now we need to zoom out because this phenomenon is so big, it's actually showing up in national economic data. And it gained its ultimate seal of legitimacy from the one institution you'd never expect to care about a pop star, the U.S. Federal Reserve. In its July 2023 Beige Book, that's the Fed's official summary of the economic conditions, the Philadelphia Fed explicitly cited Taylor Swift's concerts as the primary reason for the strongest month in hotel revenue since the pandemic began. Think about that. In a formal government economic report, a single cultural tour was credited with boosting an entire region's economy. That is unheard of. It's become such a legitimate economic force that it's now a teaching tool. The Street, Louis Fed literally held a webinar for educators called What Taylor Swift Can Teach Us About Economics, using her tour to explain core concepts like supply and demand and trade incentives. So let's look at the hard numbers behind the Eras Tour in the U.S. A study by Question Pro estimated the tour could generate $5 billion in direct economic impact. To put that in perspective, that is larger than the GDP of 50 different countries. The average concertgoer spent about $1,327 on things like tickets, travel, hotels, outfits, and food. The U.S. Travel Association put the total economic contribution, including indirect multiplier effects, at over $10 billion. This isn't just a tour. It's a rolling, precision-guided fiscal stimulus package. Unlike a government stimulus check that people might save, this spending is immediate, concentrated, and targeted directly at the service and hospitality sectors that got hammered during the pandemic. The velocity of money here is incredibly high. $1 spent at a hotel immediately becomes wages for local staff, who then spend it at local businesses, creating a powerful local multiplier effect. And this is a global phenomenon. In Japan, the tour was projected to generate over $229 million, making it the biggest musical event in the country's history. In Singapore, their 6 exclusive shows were estimated to boost the country's GDP by 0.2%, a staggering impact from a handful of concerts. In Australia, the Melbourne dates alone injected about $780 million into the local economy. And in the UK, the estimate is a boost of nearly $1.3 billion. This has led to a completely new paradigm of event-driven economic development. Cities are realizing that attracting one mega event like the Eras Tour can be more effective than years of traditional tourism. Marketing. The Singapore deal was a watershed moment. They paid for exclusivity in Southeast Asia, and it caused a massive surge in flights and hotels booked from neighboring countries. It shows that the economic power of a concert tour is now so immense that it's being used as a tool of national economic policy, sparking geopolitical tensions. Singapore made a calculated bet that the ROI in tourism dollars, GDP growth, and global prestige would far outweigh the subsidy. This is the dawn of concert diplomacy. So you have stocks moving and GDPs shifting. What's the next logical step in our hyper-financialized world? Well, how about we create a market where you can bet on her wedding date? I'm not kidding. Platforms like Kalshi, which is a federally regulated exchange, and Polymarket are creating yes-no contract markets on events in Taylor Swift's life. This is the ultimate financialization of culture, moving celebrity gossip from the entertainment section to a trading terminal. The market on Kalshi for whether Swift and Kelsey would get engaged by 2025 saw over $250,000 in trading volume. The moment the news hit, new markets popped up. Will they be married by the end of 2025? And will Swift headline the 2026 Super Bowl? A market that has already traded over $800,000. What's wild is that these markets behave just like traditional assets, with odds fluctuating based on news and speculation. There was even chatter about potential information leaks before the engagement announcement, as the price of yes contracts surged, the cultural equivalent of insider trading. This creates a new kind of alpha or market edge. Your advantage doesn't come from reading SEC filings. It comes from your ability to correctly interpret cultural signals. The very Easter eggs, Swift is famous for leaving her fans. Your edge is cultural literacy. While traders are betting on her, brands are finding clever ways to ride her coattails for free. Domino's Pizza, for example, ran a perfect combo deal priced at $19.89, a nod to her album. The promo code was 1387, combining her lucky number and Kelsey's jersey number. This is a brilliant example of what you could call marketing arbitrage, profiting from the positive externalities of a massive brand without paying a dime in endorsement fees. They identified an inefficiency in the attention market and captured the surplus for almost zero cost. So, where does all this power come from? To understand that, you have to look at the business empire Taylor Swift has built. As of 2025, Forbes puts her net worth at $1.6 billion. Crucially, she is the first musician to hit billionaire status almost entirely from her music and performances alone. This isn't a fortune built on fashion or makeup side hustles, it's built on the core product. Her music catalog is valued at around $600 million, with another $800 million from touring and royalties. Her real estate portfolio is worth over $150 million, providing a stable hard asset foundation, but the single most brilliant strategic business decision of her career was re-recording her first 6 albums. When the ownership of her original master recordings was sold without her consent, she didn't just complain. She executed a calculated financial strategy to devalue the original assets she didn't own and create brand new ones that she controlled completely. By owning the new Taylor's Version masters, she now controls both the publishing rights and the recording rights. This single move guarantees her long-term financial independence and control over her most valuable IP. What she has built is a new blueprint for artists. It's a shift from being an artist to being a vertically integrated media company. She owns her production, the masters. She controls her marketing and distribution, her direct-to-fan relationship, and she even bypassed traditional Hollywood studios by partnering directly with AMC to distribute her concert film. She is the CEO, head of production, and CMO of Taylor Swift Incorporated. And here's the great paradox that amplifies her power. She strategically refuses to do widespread commercial endorsements. She understands that the authenticity of her implicit endorsements, like wearing that Ralph Lauren dress, is her most powerful marketing tool. That authenticity is a scarce resource. Taking dozens of sponsorship deals would dilute it, making each one less impactful. By forgoing short-term endorsement money, she protects the long-term value and integrity of her personal brand. This endorsement scarcity makes her organic choices exponentially more valuable to the brands lucky enough to be chosen. So, we've dissected the stocks, the macro numbers, and the business genius. But the real root of the Swift effect is an intangible asset that you'll never find on a balance sheet: trust. The deep parasocial relationship and trust she has cultivated with her fan base over nearly 2 decades is her core asset. This trust translates into almost frictionless economic conversion. When Taylor Swift is associated with a product, the normal consumer decision-making process gets short-circuited. The fans' trust acts as the ultimate endorsement, bypassing the need for traditional marketing. This brings us to the broader fan economy or creator economy as an asset class. This is an entire category of business built by millions of independent creators, all centered on a direct-to-fan model for investors. The entire fan economy should be treated as a unique high-beta thematic sector. Its value is driven by sentiment, emotion, and cultural relevance factors that are inherently more volatile than traditional economic drivers. Because it's emotion-driven, it will likely outperform in risk-on environments when consumer confidence is high and get crushed in risk-off periods like a recession. So, finally, the big question: how do you invest in this? There are 2 ways to approach it. The first is the short-term, event-driven trade. This is the high-risk degen play. The key lesson here is from the American Eagle case study: analyze the fundamentals first. A great story cannot fix a broken business model. You have to ask, is there a plausible bridge between this cultural moment and sustained revenue growth? A sold-out dress is a PR hit, a long-term brand partnership is a revenue driver. But be warned, mean reversion is a powerful force, and these narrative-driven pops are often short-lived. The second, and in my opinion, much smarter strategy, is a long-term thematic approach, and the thesis is simple. It's the oldest rule in investing. In a gold rush, don't dig for gold, sell shovels. Trying to pick the next superstar creator is a fool's errand. The prudent way to get exposure to the fan economy is to invest in the underlying infrastructure that powers the entire ecosystem. So, who are the shovel sellers in this new economy? 1. The platforms. The social media and content giants where creators build their audiences. Think Alphabet for YouTube and Meta for Instagram. 2. Monetization and e-commerce tools. The companies that provide the direct-to-fan monetization tools. Think Shopify, Etsy, and payment processors like Block or PayPal. 3. Live entertainment infrastructure. The companies that own the venues and ticketing platforms. The big one here, controversies and all, is Live Nation. 4. Streaming services, the platforms that provide recurring royalty income for creators like Spotify and Apple Music. Investing in a diversified basket of these shovel seller companies gives you broad exposure to the growth of the entire creator economy while mitigating the risk of any single creator's star fading. You have to acknowledge the volatility. This is a high beta theme, so any allocation should be sized appropriately within a diversified portfolio. But the Swift effect has given us a fascinating look into the future of consumerism and media. The challenge and the opportunity for us as investors is to look past the dazzling light of a single superstar and invest in the durable, long-term infrastructure that will power the entire fan economy for years to come. That's all for today. Let me know what you think in the comments. Are you investing in the fan economy? Do you own any of these shovel stocks? As always, if you got any value out of this, hit that like button, subscribe for more, and I'll see you in the next one.